What is happening, crypto fam? The market is absolutely electric, and if you thought things were moving fast before, buckle up because this week is a full-blown sprint. We've got critical insights hitting the wires that could reshape your entire portfolio strategy. From massive shifts in capital allocation to the next generation of utility-driven projects, you're about to get the inside scoop that everyone will be talking about. Don't blink, because you're about to hear the unmissable updates that are defining the future of digital assets. We're diving deep into the strategies that matter and the trends that are exploding right now. Get ready for a rapid-fire rundown that you simply cannot afford to miss. Let's get straight into it. First up, we're dissecting the latest moves in Bitcoin treasuries and the critical liquidity landscape for altcoins. This isn't just about numbers. It's about understanding the new frontier of digital asset capital allocation and what it means for your investments. Are the big players shifting their strategies? We've got the details. Then, we're zeroing in on 2025 with a deep dive into utility-driven crypto presales. Why are certain models outshining the hype? We're breaking down why a particular Bitcoin mining model is capturing attention and what it means when compared to the frenzy around meme and exchange tokens. Next, get ready for a seismic shift as investors appear to be flocking to Ethereum, potentially causing Bitcoin ETFs to lose some of their steam. We're talking about major inflows and what this pivot signifies for the broader market sentiment and the dominance of digital gold. And finally, we're looking at the earnings report from a key player in the Bitcoin ecosystem. What do their Q2 results tell us about the health and growth trajectory of the digital asset market in a landscape that's constantly evolving? This is the information you need to stay ahead of the curve. Stick around, hit that like button, and make sure you're subscribed with notifications on so you don't miss a single beat. Let's go. Navigating the digital asset frontier. The world of digital asset capital allocation is undergoing a significant transformation, and understanding the interplay between Bitcoin treasuries and altcoin liquidity is more crucial than ever. This evolving landscape presents both challenges and unprecedented opportunities for investors looking to strategically position themselves in the market. As the digital asset space matures, sophisticated investors and institutions are increasingly focused on how large holdings, often referred to as treasuries, influence market dynamics and liquidity availability for smaller, yet potentially high-growth, altcoins. The concept of Bitcoin treasuries refers to the significant amounts of Bitcoin held by corporations, investment funds, and even some governments. These holdings are not just passive reserves. They represent a substantial capital commitment that can impact market sentiment and price action. When these treasuries are actively managed, bought, or sold, the ripple effects can be felt across the entire digital asset ecosystem. For instance, large-scale acquisitions by companies can signal confidence and potentially drive up the price, while significant sales could indicate a shift in strategy or a need for liquidity, potentially leading to downward pressure. Parallel to this, the liquidity of altcoins, digital assets other than Bitcoin, is a critical factor for their adoption and price discovery. Liquidity refers to how easily an asset can be bought or sold without significantly impacting its price. In a market characterized by fragmentation and varying levels of institutional adoption, altcoin liquidity can be a bottleneck. Low liquidity means that even moderate trading volumes can cause substantial price swings, increasing risk for investors. Understanding which altcoins have robust liquidity and which are more susceptible to manipulation or volatility is key to navigating this frontier. The intersection of Bitcoin treasuries and altcoin liquidity creates a complex dynamic. Large Bitcoin holders might use their Bitcoin as collateral to access liquidity for other ventures, or their decisions to hold or sell Bitcoin could influence the overall risk appetite for digital assets, thereby affecting altcoin liquidity. For example, if institutional investors are primarily focused on accumulating Bitcoin, they might have less capital or inclination to invest in smaller altcoins, thereby reducing their liquidity. Conversely, a period of strong Bitcoin performance and stability could encourage broader investment into the altcoin market, boosting liquidity. Analysts are closely watching how corporate treasuries are allocated and how this impacts the broader digital asset market. The trend towards holding Bitcoin on balance sheets is a relatively new phenomenon, and its long-term implications are still unfolding. The way these large Bitcoin reserves are managed, whether through staking, lending, or simply holding, will undoubtedly shape the liquidity conditions for a vast array of altcoins. This new frontier of digital asset capital allocation demands a nuanced understanding of these interconnected forces, requiring investors to look beyond individual asset performance and consider the systemic influences at play. But this strategic capital allocation isn't happening in a vacuum. It's part of a larger trend shaping the future of digital assets. Get ready, because next we're diving into the utility-driven presales that are set to dominate 2025. Utility-driven presales, the 2025 playbook. As the cryptocurrency market matures, the allure of speculative tokens is gradually giving way to a more discerning investor base that prioritizes tangible utility and sustainable growth models. This shift is particularly evident in the burgeoning landscape of crypto presales, where projects demonstrating real-world application and robust underlying technology are poised to outperform the often hyped meme and exchange tokens. With 2025 on the horizon, understanding which presale models offer genuine value is paramount for strategic investment. The distinction between utility-driven projects and purely speculative assets is becoming increasingly stark. Meme tokens, while capable of generating significant short-term gains due to viral marketing and community hype, often lack fundamental value propositions. Their price action is largely dictated by social media trends and FOMO, making them inherently volatile and risky for long-term investment. Similarly, exchange tokens, while tied to the success of their respective platforms, can also be subject to market saturation and regulatory scrutiny. In contrast, utility-driven tokens are designed to provide access to a service, a platform, or a specific function within an ecosystem, creating intrinsic demand. One model gaining significant traction for 2025 is centered around Bitcoin mining. Projects that integrate a transparent and efficient Bitcoin mining operation as the core of their tokenomics are drawing attention from investors seeking stability and a tangible link to the digital asset's foundational technology. Unlike projects relying solely on marketing buzz, these mining-centric models offer a clear revenue stream, often derived from the actual mining of Bitcoin. This revenue can then be used to support token value, fund further development, or even distribute rewards to token holders, creating a self-sustaining economic loop. For instance, a project like Bitfrac is being highlighted for its innovative Bitcoin mining model. By focusing on operational efficiency, access to energy, and leveraging advanced mining hardware, such projects aim to provide a more predictable and less volatile investment compared to the speculative frenzy surrounding many other digital assets. The presale of such tokens offers an opportunity to get in on the ground floor of a venture that directly benefits from Bitcoin's network security and growth, a stark contrast to tokens whose value is solely dependent on market sentiment or speculative trading. Analysts are closely observing these utility-focused presales, noting that projects with clear roadmaps, experienced teams, and demonstrable technology are likely to attract sustained investor interest. The narrative around Bitcoin mining itself, as the bedrock of the digital economy, provides a strong foundation for tokens that can effectively leverage this infrastructure. As investors become more sophisticated, the demand for presales that offer more than just the promise of quick riches, but rather a stake in a functional ecosystem, is expected to grow. This focus on utility is not just a trend. It's a fundamental reevaluation of value in the digital asset space. The projects that can offer real-world solutions and integrate seamlessly with the broader crypto economy, especially those linked to established assets like Bitcoin, are the ones likely to capture significant market share and investor capital in the coming years. While these utility plays are building strong foundations for the future, the market is also seeing surprising shifts in investor sentiment right now. Prepare yourselves, because next we're looking at a major move as investors are flocking to Ethereum, potentially leaving Bitcoin ETFs in the dust. Ethereum ETFs surge as Bitcoin ETFs face headwinds. A significant shift in institutional investment patterns is currently underway, with Ethereum exchange-traded funds, ETFs, experiencing a dramatic surge in inflows, effectively outpacing their Bitcoin counterparts. This trend suggests a potential recalibration of investor focus within the digital asset space, moving capital towards Ethereum amid evolving market dynamics and the continued performance of Bitcoin ETFs. The implications for market sentiment and the broader altcoin landscape are substantial. Recent data highlights a compelling divergence in ETF performance. On a specific recent day, Ethereum ETFs collectively attracted an impressive $443.9 million in net inflows. This figure starkly contrasts with the $219 million garnered by Bitcoin ETFs on the same day, indicating a nearly twofold increase in investor interest towards Ethereum products. This surge represents a notable milestone, marking the highest daily inflow for Ethereum ETFs since their inception, further solidifying their growing appeal among institutional investors. Leading this charge were prominent products such as BlackRock's iShares Ethereum Trust, ETH, which alone secured $314.9 million in inflows. Following closely was Fidelity's Ethereum ETF, FETH, which added $87.4 million to the growing total. These substantial inflows underscore a growing confidence in Ethereum's potential, driven by factors such as its robust network utility, the ongoing development of its ecosystem, and perhaps a perception of undervalued growth compared to Bitcoin. This increased allocation towards Ethereum ETFs comes at a time when the broader crypto exchange-traded products, ETPs, market has faced considerable headwinds. Last week, global crypto ETPs saw outflows totaling $1.43 billion, the largest such outflow recorded since March 2025. This widespread investor caution has been attributed to heightened uncertainty surrounding U.S. monetary policy, particularly the Federal Reserve's stance on interest rates and inflation. Such macroeconomic uncertainties often lead investors to de-risk, pulling capital from speculative assets. However, even within this environment of overall outflows, Ethereum demonstrated resilience and captured a significant share of investor capital. While Bitcoin ETPs experienced substantial withdrawals, Ethereum managed to retain a notable 26% of its total assets under management in inflows month-to-date, compared to Bitcoin's 11%. This suggests that despite broader market anxieties, dedicated capital continues to flow into Ethereum, signaling strong conviction in its long-term prospects. The narrative surrounding Ethereum's appeal is multifaceted. Beyond its technological advancements, such as the transition to proof-of-stake, the increasing adoption of its ecosystem for decentralized applications, dApps, DeFi, and NFTs, and the anticipation surrounding potential future upgrades play a crucial role. Furthermore, the performance of Ethereum ETFs relative to Bitcoin ETFs in August suggests that investors may be seeking diversification or alternative growth engines within the digital asset class, viewing Ethereum as a compelling opportunity. While Bitcoin ETFs did break a 6-day streak of outflows with a $219 million inflow, the sustained and even accelerating interest in Ethereum ETFs paints a picture of a dynamic market where investor preferences can shift rapidly. This trend warrants close observation, as it could indicate a foundational change in how institutional capital is allocated across the digital asset landscape. This shift in investor sentiment is a critical indicator of market evolution, but it's not the only significant development we're tracking. Coming up next, we're breaking down the latest earnings report from a major player in the Bitcoin ecosystem to see what it reveals about the market's health. Bitcoin Depot charts growth amid market fragmentation. Bitcoin Depot, a prominent player in the cryptocurrency ATM sector, has released its second quarter earnings for 2025, offering a crucial look into the company's performance and strategic positioning within a rapidly evolving and often fragmented digital asset market. The results provide valuable insights into operational efficiency, market expansion, and the company's ability to navigate the complexities of regulatory landscapes and competitive pressures. In its latest financial disclosure, Bitcoin Depot reported key performance indicators that shed light on its operational scale and revenue generation. The company operates a vast network of Bitcoin ATMs, facilitating the conversion of fiat currency into Bitcoin and other cryptocurrencies. This direct on-ramp service positions Bitcoin Depot as a vital infrastructure provider, particularly for individuals seeking to access digital assets through more traditional, tangible means. The Q2 earnings report details the volume of transactions processed, the total value of cryptocurrency exchanged, and the company's revenue streams, which are primarily derived from transaction fees. The company's strategic focus appears to be on expanding its physical footprint and enhancing the user experience at its ATM locations. In a market characterized by diverse access points to digital assets, from online exchanges to decentralized platforms, Bitcoin Depot aims to differentiate itself by offering convenience and accessibility, especially in regions where digital banking infrastructure may be less developed. Their expansion efforts often involve securing prime locations and forming partnerships to increase the visibility and usability of their ATMs. Furthermore, the earnings report likely addresses the company's efforts to adapt to the dynamic regulatory environment that governs cryptocurrency operations. Compliance with anti-money laundering, AML, and Know Your Customer, KYC, regulations is paramount for entities operating physical kiosks that handle financial transactions. Bitcoin Depot's ability to maintain compliance while facilitating accessible crypto transactions is a key factor in its sustained operation and growth. The fragmentation of the digital asset market presents both challenges and opportunities. While numerous platforms and services compete for user attention, this fragmentation also highlights the demand for reliable and accessible entry points into the crypto economy. Bitcoin Depot's business model directly addresses this need, serving a segment of the market that may be more comfortable with physical transactions or less inclined to use purely online services. Analysts reviewing Bitcoin Depot's Q2 2025 performance will likely be examining metrics such as same-store sales growth, the rate of new ATM deployments, and the profitability per machine. The company's ability to manage operational costs, including hardware maintenance, network connectivity, and security, will also be critical factors influencing its bottom line. Moreover, the report may offer guidance on future growth strategies, including potential diversification into other digital assets or services, and its outlook on market trends. Ultimately, Bitcoin Depot's earnings report serves as a barometer for the health of the physical crypto access point sector. Its performance reflects broader trends in cryptocurrency adoption, user engagement, and the ongoing efforts to bridge the gap between traditional finance and the burgeoning digital asset economy. The company's strategic initiatives and financial results provide a valuable case study in navigating the complexities of the global crypto market. These financial results offer a clear snapshot of one segment of the market, but the overall sentiment is being shaped by much larger forces. And that wraps up our deep dives for today. But before you go, let's hit you with a lightning round recap of everything we covered. And that's a wrap on today's Market Pulse. We saw institutional investors shifting gears, with Ethereum ETFs pulling in massive inflows, while Bitcoin ETFs experienced a slowdown. We also explored the rise of utility-driven presales for 2025, highlighting Bitcoin mining models as a stable alternative to hype tokens. Plus, we analyzed Bitcoin Depot's Q2 earnings, giving us a glimpse into the physical infrastructure side of crypto. Don't forget to smash that like button if you found this valuable, subscribe for more, ring that notification bell so you never miss an update, and share your thoughts in the comments below. Follow us on all social platforms to stay connected. We'll see you in the next one.